Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Thanks to Policygenius for sponsoring this video, but more on that later. In today's video, we're gonna talk about the phrase buy, borrow, and die. As you can see right there, that's my drawing of a, never mind. So this is basically how the rich stay rich by taking advantage of the American tax system. The phrase buy, borrow, and die was created more than 20 years ago by Professor Ed McCaffrey, who uses this simple phrase to summarize the American tax system in a nutshell. The basic premise is that the rich buy something like an asset, such as a stock or real estate, for example. They borrow against these assets instead of selling them, and finally, they die and the estate goes to their heirs or beneficiaries. In this video, we're gonna take a look at these 3 steps in more detail and how the rich use buy, borrow, and die to stay rich. Stay tuned until the end of the video where I give my opinion as always. Step number 1 involves buying an asset. So in the intro to this video, I gave the example of buying stocks or real estate. I'll give you a quick example of both of these things in real life. Let's use my M1 Finance account, for example. At the time of this recording, I have about $240,000 sitting in M1 Finance. If you don't include my SEP IRA, I have about $210,000 in stocks that I can borrow against in my taxable portfolios. An even better example would typically be real estate. Remember, I came from a commercial real estate career before starting my YouTube channel. I would see the buy, borrow, and die strategy implemented all the time with people that had net worths of hundreds of millions of dollars. These rich families would own apartment buildings, office buildings, and they would just simply borrow against these assets, refinance, pull out the money tax-free, and live off that money while the building still cash flows even with the new debt. Max loan to value, baby, LTV. They never incurred capital gains taxes because they never actually ended up selling the building. They were simply using it as an asset to borrow against, AKA collateral. Real estate is a good asset to own because typically over time, its value at least keeps up with inflation in most cases. Depending on the location, it's not super volatile either, and you can typically depreciate against it, which will help reduce your taxable income. Oh, and most banks like to borrow against real estate, and they like to lend against real estate if the numbers work and it passes underwriting. This collateral takes us to the next step in this process, which is to borrow against these assets. So the next step is to borrow, which is exactly what it sounds like. You borrow against the asset mentioned in step 1. So say, for example, I get in a cash crunch and need cash. Let's pretend I have no money. Let's pretend the only assets I have are sitting in my M1 Finance account. Most people would simply take a certain stock or ETF and sell a portion of it in order to take out the cash that they need, right? Well, using this strategy, you would be wrong. This is not a pitch for M1 Finance, but the reason I'm using it is an example because you can borrow up to 35% of the value of your portfolio at 2% interest. This is essentially free money based on the rate of inflation at the time of this recording. Take a look at this chart provided by Morgan Stanley. This chart right here is explaining the borrowing boom, which shows securities-based and other non-mortgage loans to wealth management clients at Morgan Stanley. Since 2016 compared to now, the amount that people have borrowed against their stock portfolios has more than doubled. Let's also use the commercial real estate building from step 1 as an example. Let's pretend that the net operating income of a building causes it to be worth $1 million in value. If the owner of this building wants to take out an 80% loan to value cash out refi on this property, they would be getting $800,000 tax-free. This is the same concept as borrowing against your stock portfolio in M1 Finance or at Morgan Stanley, for example. These people are avoiding creating a taxable event by selling their stock in the example given earlier, but they're still getting the cash that they need to live off of by doing so. So not only are they foregoing a taxable event, but these assets are also typically growing in value because of all the money printing we've seen over the years. The rich are getting richer and the poor are staying there. Step 3 is the most important right now, so stay tuned, but a few words from Policygenius before we get to that. There's a lot to be thankful for this season, and if someone in your life relies on your financial support, whether it's a child, aging parent, or even a business partner, you need life insurance. You could save 50% or more on life insurance by comparing quotes with Policygenius, and you could save $1,300 or more per year on life insurance by using Policygenius to compare policies. Getting started is easy. First, head to policygenius.com/whiteboardfinance. In minutes, you can work out how much life insurance coverage you need and compare personalized quotes to find your best price. When you're ready to apply, the Policygenius team will handle the paperwork and scheduling for free. Policygenius never sells your information to other companies, and Policygenius doesn't add on extra fees. The licensed experts at Policygenius work for you, not the insurance companies, so you can trust them to help you navigate every step of the shopping and buying process. Head to policygenius.com/whiteboardfinance to get started right now. The third and final step, literally final, is when you pass away. When you die, your estate typically goes to your beneficiaries or heirs. What typically happens now is that the loans can be paid off by selling the assets that you borrowed against in the first place, and the heirs inherit these assets at a step up in basis, at cost basis. So say that $1 million building that we bought, let's call it 20 years ago, we talked about it earlier, it grew to a value of $2.5 million, for example. You can either borrow against that building again or sell it for $2.5 million without realizing the capital gains tax because the heirs are getting it at a $2.5 million cost basis at the time of your death. So there's a popular tax strategy for real estate called a 1031 exchange, where if you sell a property and find a like and similar property within a specific time frame, you actually forgo the capital gains tax on the original sale of that property. So every real estate developer that I know did this over and over and over again with the intent of passing away without ever paying those capital gains taxes. So if we wanted to use stocks as an example, or ETFs, let's pretend I bought an ETF with a cost basis of $10 in the year 2005. And let's pretend that ETF has grown to $1,000 per share by the time I pass away. If my heirs choose to sell that ETF at $1,000 per share today, they will pay no capital gains tax because they had no gains. They received the stock or ETF at a cost basis of $1,000 per share. They can then pay off the loan with the proceeds of the sale of the ETF if they choose to do so. Get it? Okay, so now that you have a better understanding of what buy, borrow, and die is, why isn't everyone loaded to the gills with debt and have a 99.9% loan to value ratio on every single asset they own, right? Well, most Americans are. Just kidding. Well, this is obviously not rainbows and unicorns. The numbers still have to work even after you take out that cash out refi on a property, for example. The stocks can go down that you're borrowing against, and you're gonna get margin called to fulfill the difference to keep that 35% ratio on M1 finance, for example. So it just depends on what you're comfortable with and the things that you're using the money for. If you're using that money to make more money, that could be a viable strategy. That can also be a double-edged sword. That can be super dangerous. So most people use this for estate planning and wealth building purposes. There are estate taxes, there are wealth taxes. There's a lot of stuff that's being mulled around in Congress right now as we speak, especially the $600 for every bank account, which is just ridiculous in my opinion, but I'm not gonna go into that in this video. And I don't wanna talk politics either, because this video is sponsored by Policygenius. But regardless, I think that this is a double-edged sword. Leverage is a tool. Remember that, if all you have is a hammer, everything looks like a nail, so just be careful. You don't want to go down the rabbit hole of 2008, where I know a ton of real estate developers that, banks started calling loans due, the properties weren't cash flowing or they were underwater. Boom, you go through bankruptcy, foreclosure, your empire is done overnight. So just be super careful with leverage, be careful with this strategy. I know a lot of people that have used it to its full efficacy, and I also know people that got burned by it. So again, I'm not Dave Ramsey. I don't wanna be Dave Ramsey at all. But at the same time, I'm not your high-flying real estate developer who's leveraged to the gills with a million houses that barely cash flow either. The golden middle is something where I always invest in. I can sleep well at night using that. So this is just another tool in your toolbox. And as always, I hope you got value from the video. Thank you so much and have a prosperous day. I own 36 houses that barely cash flow and I have 10% equity in each one. Let's go, baby. Invest in real estate. Be careful, y'all.